Hello guys, welcome back in our tutorials. This is our night classes, our night discussion classes at WhatsApp. Remember, our official classes were gonna be done at Zoom app, and it's gonna be a professional classes than this. But this one's just a discussion. Okay, I'm making this video in order to be able to help those who are left behind in our discussions. All right, as we go about this one, okay, I want to introduce you some important concepts of accounting. Okay, we start by defining assets. Okay, this is learning unit number 2 and also 3. This video is covering those learning units. Okay, it's very important that, okay, assets are defined as all resources in an entity that is controlled by the entity and represent cash. Assets are divided into current and also current non-current assets. Okay, so when we speak of assets, we speak of all the resources that are controlled by what? By the entity. So all positions which have monetary money or monetary value for the enterprise or the business, but are different into or are divided into what? Current assets and also non-current assets. Okay, now we move on to types of assets. We have types of assets, which is land and building, vehicles, equipment, fixed deposit or long-term investments. All those are all non-current assets. Okay, by looking deeply in these types of non-current assets, we know a business need land and building in order to operate. Land and building is just, it is simple, it's just a premises or a building bought for a running of what? Of the business. And then the vehicle is all means of transport that the enterprise or the business has bought for use by the enterprise or the business to transport goods and services from one place to another place. So you need a transport to transport your goods and services into your customers. Okay, number 2, equipment, or number 3, equipment, all items needed to run the business, e.g., cash registers, chairs, and also computers. All those computers, all those cash registers that are used inside of the business are called what? Equipments. Okay, and then now the fixed deposit or a long-term investments is all about the surplus funds which are not going to be needed in the foreseeable future, and it can be deposited as a fixed deposit which with a banks or other financial what? Institution. Deposit, fixed deposit, yeah, money that is deposited in a business. Okay, can be an investment. You can also invest by taking your sum of money and deposit into the bank, and then you will get an interest each and every year. Okay, now we move on to the current assets. We have done about non-current assets. Moving on to the current assets, we have inventories, we have trade receivables, we have bank and also short-term savings. Those or these are all current what? Assets. Okay, uma ke sikhuluma ngama-inventories, we talk of the trading stock of the business. It is all about goods that are bought in order to resell them at a higher price. So okay, as you are running your business, your own business, so you have to buy some goods or services from your suppliers in order to resell them to your customers, but you will add a certain percentage as you need what? The profit. All right, okay, about debtors or trade receivables. Trade receivables are also called what? Debtors. Debtors are people who buy goods or services on credit from the entity. They therefore owe the entity money. So okay, the entity or the business can sell goods or services on credit. So those people who are owing or who are buying goods or services from the business on credit are called debtors. All right. Number three, we come across with bank is where a cash deposited in the current bank account of the entity or the business. Before you can run your business, you need to open the bank account, a business bank account, so that all income that you received each day, you take it and deposit it into your bank account as a business. All right. We're moving on now. We have done about this thing of current and also non-current asset. But another thing that I want to emphasize here is that when we are talking about a current assets are all cash or possessions of value that can be converted into cash within 1 year. So a business can be able to make money through current assets within 1 year. 1 year is having 12 months. So when we talk of stock, we talk of debtors, we talk of bank, we talk of short-term savings. So those items can be converted into cash within 1 year. But when it comes to the non-current assets, now it's take long for a business to make cash. So it's can be more than 12 months, more than 1 year. It can take 12 years, can take 5 years, can take even 20 years to make money. So such as vehicle have a lifelong inside of the business. So we, yeah, and also land and buildings. Remember, a vehicle have a decreasing value, but land and buildings have increasing value. Yeah, appreciator. Right. So it's very important for you to know what is the difference between a current asset and also non-current assets. Current assets can be converted into money within 1 year, but non-current assets can be converted into money longer than 1 year. And as well, all non-current assets are bought not for the purpose to sell them, but to use inside of the business in order to generate what income. But yeah, so yeah, need to master that. Okay, let's move on. We to the very important thing. Bayakutshela about and all assets increases on a debit side. So nje, all assets, if I'm saying all assets, all land and building, vehicle, equipment, long-term investment, what inventories, trade receivables, bank, and short-term savings are increasing on a debit side, but decreases on a credit side. So that must be on your mind. Okay, now we are done about assets. Coming to the liabilities. Liabilities are the debts of the business. Okay, if you have a liability in a financial terms, it means that you are owing money to someone or to some entity. Liabilities are divided into current liabilities and also non-current liabilities. Okay, what is a current liabilities? Current liabilities refers to the debts that will be paid off within 1 year. So okay, our current liabilities can be paid off within 1 year. So it can ingaba isikweletu esingathatha only 6 months, singathatha only 12 months. So siyibiza ukuthi yini ke leyo? It's a current liabilities. But non-current liabilities are the debts that will be paid off over more than 1 year. Okay, now these types of debts are taking many years to be paid off. Maybe it can be a debt of 20 years, 15 years, and even more. All right. Okay, now types of liabilities, we have mortgage bonds and also a long-term loans. Those are non-current what liabilities. Mortgage bonds usually are used to purchase what a land and building. Actually are used to purchase a land and buildings. So nje isikweletu sokuthenga umhlaba nama building where you're gonna run your own business. Okay, and now coming to the long-term loan. Long-term loan is the money that the enterprise borrows from a bank or any other financial institution for more than 12 months or more than 1 year. So people who are providing us with money. So we know that we will come into agreement when it will take how many years for our business to pay or to pay in fully. Okay, moving on to the current liabilities, we have a creditors, we have a bank overdraft, and also a short-term loans. Okay, creditors, guys, are people who provided goods or services to the enterprise on credit. The enterprise therefore owes them money. Okay, now the enterprise also can buy something on credit. As it also can sell something on credit, it as well also can buy something on credit. So people who are providing goods or services to our business on credit, we call them what? A creditors. All right. Moving on to the bank overdraft. Bank overdraft, it is where the enterprise withdraws more money from its current bank account than what it had in the account. So there is an over withdrawing money from the bank account of the business. For example, if the business wants to buy the assets worthy 400,000, maybe we only have 200,000 in our bank, so we need to negotiate with a bank to buy that particular what vehicle. So there is a debt there is a liability there that we need to pay at the end of the day. And then the short-term loans is a loan that can be payable in 6 months or 12 months. Okay, it's a short-term loan, it's payable within 12 months. Okay, move on. Now they tell us ukuthi all liabilities are increases on a credit side but decreases on a debit side. So it's unlike for assets. Now my liabilities also increase vele got credit side but decreases on a debit side. Okay, moving on. Let's look owner's equity. Owner's equity is the remaining interest in the assets of the business after deducting all its liabilities. Equity represents the interest on owners in the net assets of the entity. So we take assets minus liabilities, the remaining money, it will be called what? Owner's equity, because it is the remaining interest. Remember, when a business owner intending to start a business, he or she must invest their money to the business. Then at the end of the day, they will get interest or a profit from what they have invested. Okay, types of owners equity, we have different types of owners equity. First, we have types of owners equity which are increasing owners equities, and also types of owners equity which is decreases owners equity. Okay, we have incomes and capital. These types of owners equity, they increases owners equity on credit side, they increases owners equity on credit side. Okay, then sibe nama expenses drawings, wona ke a decrease ama owners equity on a debit side. So ke akufani guys, sinezinto ezibakhuphulayo sibe nezinto ezibanciphisayo. Ama owners equity are having things or accounts which increases them and also decreases them. Incomes, capital are all elements of owners equities which increases owners equity on which side? On a credit side. And our expenses and drawings are all items, are all elements which decreases owners equity on a debit side. All right, we move on. Okay, we have done about this one, guys. We have done. So this is very very important for you to know. I'm just giving you a clue nje before we can start our official classes nje. Yeah. Okay, let's go to the double entry principle. This is a last thing we do. A double entry principle. Okay, I'll just explain a few things. It stipulates that for every debit or left entry, there should be a corresponding credit or we write entry for the same amount. This means that you should record each transaction at least two accounts. So again, each transaction, a transaction which you got from the business or to the business, you must identify two types of account that must be affected, and also these two types of account, the first account must touch a debit entry, and also the second one must touch what, a credit entry. Okay, ngizoku-explaina ke lokho kwi-official class yethu ukuthi ena kwenzeka kanjani when we are using the practical work. Okay, to be consistent, all entities must apply the following rules. All assets and expense accounts must be increased on the left hand side, okay, and then it decreases on a right, which is a credit side of the account. Okay, assets and expenses siyatshelwa kuthiwa a-increase kuphi kwa-debit side, but a-increase kuphi, a-increase kwa-debit side but a-decrease kwa-credit side. Okay, all liability and income accounts must be increased on the credit side or right hand side, right, and decreases on the left hand side, which is debit side of the account. Right, or let me just draw something for you so that you will see. Masikhuluma nge-T form, nge-T account of a business, and then we done for today. Okay, I will draw something for you so that you will understand. Okay, here is the account, and let me say maybe it's a bank. Yeah, okay, this is a T form. Let me say this is a bank account. Yeah, okay, on your right hand side you have a credit side, on your left hand side you have what, a debit side. Yabo? Okay, sorry about the spelling. Alright, alright, this is how you draw the account. Okay, remember, a bank account is a type of asset. Obviously it will increase on a debit side, angithi, it will increase here on a debit side, but decrease here on a credit side. Ne? Okay, the bank account increases on a debit side but decreases on a credit side. So this is just an example of what, of the account. Okay, let's just take one transaction, guys, and then I close this lesson. Let's just take one transaction, we do it, and then I close it. Right, okay, here it is the transaction. Now we analyze the transaction now. We analyze the transaction. Okay, let me, okay, maybe the transaction says owner of the business contributed with how much money, maybe 100,000 into the business. Okay, the owner of the business nje uthola ibonus emsebenzini, waseya contributor with 100,000 into the business. Okay, remember, okay, let's just analyze this transaction. Okay, this is a transaction, this is a transaction. It's presenting what, the inflow of money into the business. So the business receives money from the owner because the owner took 100,000 and deposited it into the bank account of what, of the business. So how can we analyze this transaction? Okay, firstly we need to ask ourselves how many, or okay, vele imile i-rule it, and you need to identify two types of account per transaction, ne? So we need to ask ourselves which those two types of account that must be affected by this what transaction. Obviously the bank must be affected because the money is cash, ne? The first one is gonna be a bank, the secondly one is gonna be what, a capital. Why is a capital? Because anything that is invested by the owner is a capital, ne? Anything that is contributed by the owner is what, is a capital. So let's just record this thing we mati form account. Okay, we go like this. We start by recording the bank, ne? Here is a T form of the bank. Okay, on your left hand side you have a debit side, on your right hand side you have a credit side, then in the middle you have a bank account. Alright, siyarekhoda ke manje guys. How much money is contributed? Remember, you need to ask yourself, bank is a type of asset, so it will automatically increase on a debit side but decrease on a credit side. Okay, siyarekhoda ke manje, this money is capital. It's capital ngithi. Then how much is 100,000? Okay, 100,000. Two types of account that must be affected. Sesidweba ke manje ugcina. We are constructing the last one. Right here, the last one. Right here is the last one. Obviously, on your left hand side, debit side, on your right hand side, credit side. Okay, and then in the middle you have what, a capital account. Okay, a capital account, I told you that is a type of owner's equity, and then it will increase on which side, increase ama owner's equity on a credit side. Okay, let's go back. Obviously it will increase on a credit side. Okay, present it as a bank. I'm sorry. Okay, here is a bank. How much money? 100,000. It done. Okay, two accounts must be affected, and then EW entry principle itini it ena the double entry principle stipulates that for every debit left entry there must be a corresponding credit entry for the same amount. So now we have applied that on the debit side, same amount, and also on the credit side, same amount, in two types of what, of account. So each and every transaction you do this thing, guys. Okay, for now let's close this lesson. Those who want to register in my tutorials, you can inbox me, and then I will register you. Yeah, I teach and also help with assignments. So okay, I'm waiting for you in order to start a class. Next week we start our official classes. We priorly start with free 4 free classes, and then the rest it will be a paid classes. Thank